Okay, right. So question 6 to 10. Let's try a different pen color. Let's do something there. So question 6 to 10. And again, of course, you have read this before attempting it. We have two scenarios here dealing with. First of all, what we're really looking at here is our events after the year end. So we're looking at subsequent events. Yes, remember the chapter on this. And we talked about what happens post year end, between year end and when you actually sign the accounts. And the year end here is the 31st of March, and we have events happening in this period up to the signing of our accounts. And we've noticed a few anomalies of sorts, if you like. And the first anomaly is to do with a customer liquidation on the 15th of May. On the 15th of May. So it says that, well, so first of all, the important thing, I think we might have talked about this, is checking and testing materiality. So you just make sure you have the profit before tax. It is the common one, and you need for it to be material, it's 5 to 10% of profit before tax. That's where you're going, and that's what you will usually be given. Right. So 15th of May, OCC receives a letter informing it that one of its customers has gone into liquidation. So here's your year end, and they've gone into liquidation after the year end. And so the argument here is determining whether or not this is an adjusting event or non-adjusting event. Now, of course, we know that adjusting events, for us to call something an adjusting event, which means we want to go back to the year to actually change the figure, means that we had evidence as at the year end that this event was going to happen. And evidence in this case would be that we had a client who was not returning calls, who was not able to pay, and was struggling, and had it probably exceeded the usual common credit limit and timing for credit. So whatever, 30 days or 45 days. So now when they finally go bankrupt, we cannot say we didn't know. We had no idea that this is a completely new idea or a new event taking place. So what do we have? We have 50,000 included in receivables with regards to this debt. And so the first thing to do is to assess it. Well, the truth is, it is an adjusting event. That's the first point. It is an adjusting event because it is a receivable that's gone bad, to which we had evidence. And the next thing we need to assess is the question of materiality. So 50,000 divided by 7 million takes you to 0.7%. So I've done this on my own, and I can see they've actually done it for you as well. And it says here that on the post year end, a regulator has informed you that new regulations will come into force in the future, and they have estimated this is 1 million to spend on this. So first of all, you had no idea before your year end that this was going to be an issue. So it's not an adjusting event. It's happened before you're signing off. So it's something that you would disclose, if you like, or bring to the attention of future shareholders. So this is a non-adjusting event. That's the important thing here. It's a non-adjusting event that we need to bring to the attention of our clients. So what do we have here? The debt of 50,000, if you like, it is an adjusting event. So it's an adjusting event. Sorry, that's not what they're asking. It says that, first of all, the debts of 50,000, 0.7%, it is not material. Right? It just isn't. It's just not material. It's less than 5 to 10%. It's not material, as it represents 0.7%. But in of itself, the event itself is an adjusting event. Right? It's an adjusting event. The cost of complying, where it represents 14%, is material. So it is a material event. So this is not material. This is material. Right, and this is a non-adjusting event. Right, we're not going to start to change. What would we even do? Put through a provision for something that we could possibly not do in the end. So we might still choose not to do it. We might choose to pack the company up because the cost of compliance is too high. So that in itself makes it impossible to actually put a provision through anyway. So there we are. So those are your answers there. not material, adjusting event, material, and then non-adjusting. Right, next question. Which of the following is most appropriate with regards to this liquidation? Now, this liquidation, I mean, what you should do, remember that we put together a management letter which has a list of all misstatements, material and non-material. All misstatements, making recommendations for these to be adjusted. So good accounting practice, which is what we're really saying here, that we want to make sure that the accounts themselves align as close as possible to the financial reporting standards, and so we wish to adjust all of these things anyway. So yes, it's not material, but we would prefer, it says most appropriate, if you like. So we want it written off. I mean, it's immaterial. And once you've written it off, there is no need to start disclosing. It's immaterial. So disclosing starts to create the idea of it giving it some importance, but it is immaterial. So you just write it off like you would a normal debt. In the year, in the 31st of March 2005, it's just a normal regular debt. It's not material at all. It's minimal, quite irrelevant. Right, and then with regards to the new regulation, this is what they're asking here. Well, we need to disclose, we need to sort of let people know what's happening. And so it says the financial statements should be amended. No, we're not amending. Financial statements should be amended. No, we're not amending. Financial statements in terms of a provision, so we're not doing that. It does need to show. So it's about a disclosure that needs to be made about the impact of this event. It is a non-adjusting event, and so therefore a disclosure is required. Right. This next question talks about the liquidation. So just taking the liquidation on its own, that's why, like I've always highlighted, these things need to be talked about in isolation, because otherwise we will have different ideas if you start bunching them together and agreeing that a number of them would work. So taking the liquidation in isolation, remember that the liquidation itself is immaterial. The figure of 70 is 0.7%. So that in itself means it's immaterial, it's irrelevant. So the accounts are still true and fair as they are. So the accounts do give a true and fair view, and we're giving an unmodified opinion. So this was the last thing we covered in our classes, didn't we, last week? So we have an unmodified scenario, and we have something along those lines. The next one says take the new regulation. So this time we're looking at the new regulation in isolation. And so focusing on the new regulation in isolation, if you don't do anything about it, as in you fail to disclose it, well, then it is certainly not unmodified. The question then becomes, how uncomfortable am I with this misstatement? Because you have clearly refused to put into the account something that is material, but we would argue that in isolation it probably is the only thing, so therefore it'll be qualified. It'll be qualified, right? It's not perverse. Both of these are perverse opinions. All right, remember we had a table, didn't we? Remember this table? Yes, and we had qualified, perverse. So, well, material, not perverse, material and perverse. And then, if you like, we had two reasons. I've said that before. Gap alignment, so as close as close as possible to the financial reporting standards. And then we have here limitation of scope. So you just can't get your hands on the evidence. There's not enough evidence to prove. But here you can clearly see what's going on. It's isolated, so it's qualified except for. Yes. And so here we have here, and this of course here would have been qualified except for, adverse, not true and fair, and here would have been disclaimer of opinion. Yes. So it's not adverse, so because it's not perverse, disqualifies these two. So it's qualified, and therefore qualified except for. So the accounts are true and fair except for this failure to recognize this disclosure. Cool, great stuff. Okay, and that's the next 5.